I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a guest who hasn't been on in a while. He's got pretty deep Wall Street experience, also runs his own website. I'll get to him in just a minute, but I want to kind of lead up to his introduction because this is one of the first things we're going to talk about. And I want to start with a cartoon. I know this is bizarre, but it's a cartoon that has a panda bear that is hitting a car licensed with Wall Street on it. And it says, uh-oh, looks like a bear market. Now, this would be funny, a panda bear signifying China. This would be funny if it wasn't so serious because China is selling treasury bonds in U.S. paper. And the person I want to have on to talk about this is Craig Hemke of TF Metals Report. Craig Hemke, thank you for joining us today from the great state of Kansas.
Greg, it's always a pleasure.
You know, this thing about the Chinese bonds, which isn't getting much play, but is a huge deal, not only because China has, some trillions of dollars of U.S. debt, but the rest of the world, according to John Williams, has, more than 16 trillion of liquid U.S. assets. And, as a farm boy from Missouri, what we try to do is get one cow to go through the door, and you could get them all to go through the door after that. And I'm talking about if China is selling their treasury bonds, everybody else is going to go, what? Excuse me, do we need to sell? So can you tell me how serious this situation is with China, evidently who has been selling for a couple of weeks now, treasury bonds to stabilize their currency, stop a carry trade, QE in reverse, according to Zero Hedge. Yep. Let me give you your take on China selling treasury bonds and how serious and how this could get wacky, out of control.
Well, the short version of the story, if you've got to back up the clock a couple of months, the Chinese stock market had reached kind of a mania phase, kind of a manic blow-off bubble where, there were pictures all over the internet of Chinese housewives, day trading like the E-Trade baby. And as that began to melt down, it takes on its own momentum, just like any bursting of a bubble or any crashing market. The Chinese had tried to stop that by putting in halts of different stocks, halting the market, all that type of thing. What seemed to break the camel's back, though, was that moment, about maybe 2 weeks ago now, when it was finally admitted by the IMF that they had no intention of including the Chinese yuan in their basket of currencies that they use, called the SDR, the special drawing right. That seemed to give China, at least they felt like they had to go ahead to begin to devalue their currency because, the old Keynesian line of thinking is if you can cheapen your currency and devalue it, it makes it more competitive. I mean, you and I know that seems kind of an oxymoron. We're going to make something less valuable and therefore make it more competitive, but that's the world of economics these days. And so they devalued their yuan, their renminbi, whatever currency you want to call it, against the dollar. And that sent shockwaves throughout all of the foreign currencies around the world and led to such an exit from the yuan that it kind of overshot what they had in mind. And suddenly the Chinese were put in a position where they had to defend the currency and try to bid it back higher. To pull that off, they started liquidating their foreign currency reserves. A large balance of that is U.S. treasuries that they've bought from us over the last 20 or 30 years. It has always been the big riddle, I shouldn't say always been, but for a number of years now, we've all wondered, when will the Chinese begin to liquidate that big, massive amount of U.S. treasuries that they have in their foreign currency reserves, and how could they do that without disrupting the treasury market? If you want to go out on a limb a little bit, there have been folks on my site that I think that have theorized, and I think deservedly so, theorized that maybe the Chinese did this somewhat on purpose to create the conditions causing this global stock market meltdown. When that happens, you get people rushing into safe havens. You get people rushing into things like U.S. treasuries. And if you have suddenly this global demand for U.S. treasuries, it creates the conditions that the Chinese could liquidate, some say as many as $100 billion worth, without really moving a needle. You have equal amounts of buyers and sellers. So I don't know, that's kind of a theory at least as to whether there was some intention behind it on their part. But what they ultimately had to do was liquidate treasuries, convert that into dollars, and then use those dollars to buy their own currency to prop it back up. It's a convoluted world that we live in. It has caused repercussions all around the globe in terms of global stock market meltdowns, and we barely survived one back on Monday. The markets have been able to be kind of propped back up as we've gone through the week there last week. But We'll see. I don't think this is anywhere near over. The signs are still out there that that the world is pretty shaky on a pretty shaky foundation. As we get past Labor Day and head into September, it's probably only get pretty dicey again.
How bad could this get with China selling bonds, and couldn't other countries start selling their and liquidating their treasury debt?
Absolutely.
Just speculate here. How bad could this get? I mean, what's the fear here?
That's the bell cow, like you talk about. How many other, you might call them emerging markets, you could call them creditor nations, that are all the other countries that are dollar creditors. They make up the BRICS, the Brazil, Russia, India, China, South Africa coalition, if you will. They're the ones that are, they've been selling stuff to us in the U.S. now for decades. In return, they get dollars, and what are they going to do with them? So they reinvest those dollars into treasuries. They got to put them somewhere. And then they collect interest from us. A fun thing to talk about sometime, Greg, is, we all talk about the Chinese military budget, and they're building islands out of nowhere in the Pacific. And where do they get all that money? Well, the Chinese military budget's something like $500 billion a year, but they're collecting $700 or $800 billion a year from the U.S. taxpayer in interest payments. So we're giving them the money to expand their military. We're paying them to do it, if you want to look at it that way. But everyone has wondered, how could the Chinese ever liquidate their treasury portfolio without really causing havoc to the U.S.? They hold those cards. If they want to ruin our economy, in a sense they can, because you start selling bonds in a massive amount, it drives down the price of the bonds. As prices of bonds go down, interest rates go up. That's kind of that inverse relationship that most people understand. And we're just not in a position where we can stomach higher interest rates. The Fed will grumble and rumble these next couple of weeks about a 25 basis point or 1/4 or 1% hike in the Fed funds rate on the very short end. But what we can't afford is anything going up on the long end, because already we've accumulated, as you know and your listeners know, $18 trillion plus of national debt. The line item on the federal budget of interest on the national debt has actually been able to be held steady the last few years, as they have shortened maturities and lowered rates on that accumulated debt. But if rates were to suddenly go to 5%, 8%, that line item, interest on the national debt, would explode. The deficit would explode. It would be a complete calamity. It's probably where we're headed eventually anyway. But if the Chinese were to start dumping bonds, willy-nilly, haphazardly, it could get sideways pretty quick.
Is that what Greenspan is warning about? I mean, this kind of a scenario that there's a bond bubble and it could blow up. I mean, can we just take that into consideration with China being the lead bell cow?
Exactly. They could easily blow the whole thing up themselves, and that's where people have said, well, they never will, because they can't ruin the value of their own foreign currency reserves. They'd be shooting themselves in the foot. Okay, but look what they've been able to do this week. They've been able to dump as much in the last 2 weeks as they have dumped this entire year. I mean, this has been an ongoing process. They stopped accumulating 2-3 years ago. They've been holding steady the amount of U.S. debt that they hold in their foreign currency reserves. They've actually, in the first 7 months of this year, had already eliminated about $100 billion worth. In the last 2 weeks, they've eliminated another $100 billion worth, it seems. And they've done it because of the other global conditions. They've been able to do it without disrupting the global financial markets, or at least driving interest rates higher. Yes. So there is a way for them to do it. And again, I don't know if this was all part of some big plan, if this was something that they intended to have it work out this way, but it's worked to their advantage, and they've been able to draw down, like I said, at least probably 10% of their treasury holdings just in the past couple of weeks.
Do you think that this whole thing could, as Greenspan's warning, do you think he's doing this for disinformation purposes, warning of a bond bubble, or do you think there really is a bond bubble and he wants to, save his integrity and his legacy by, well, I warned that there was a bond market, explosion coming. What do you think? Or do we have a bond market explosion coming?
Yes, at some time eventually. Just because mathematically the debt-based system is unsustainable. It's now grown so large, and the amount of continued debt that it takes to service the existing debt makes it all move exponentially against you, and it is spiraling toward an eventual failure. Again, though, I just want everybody to think about that from just a simple mathematics perspective. There was just a report this week. The Congressional Budget Office puts out their thing that says, the deficit for the next fiscal year is only going to be $450 billion. Now, without arguing as to whether that's accurate or not. Let's just take them at face value at $450 billion. Lion's share of that deficit, probably 2/3 of it, is interest on the accumulated debt. And the way that they've been able to manage that at the Treasury Department is by shortening the yield as far as they can and minimizing that interest rate that's paid on the existing debt. What cannot be afforded at this point is to have the interest rate on that existing debt as it matures and has to be rolled over double or triple. Because then you go from $300 billion a year in interest to $900 billion a year in interest. And now your deficit, instead of being $400 billion, is $1.2 trillion.
What are they going to do to stop that?
Well, that's the problem. You can't. It's not stoppable. It's not sustainable. And at some point, it just simply collapses. And that, as much as the pundits and the money managers and the talking heads on financial TV want to convince everyone that, oh, everything's fine, and tomorrow is going to be just like yesterday, it's just bliss and nirvana, eventually it's a mathematical certainty that the music stops. And getting it back to China, we have ceded control of that to them. They did not have an interest in creating some type of new global financial system or paradigm in 2008 because, frankly, the foundation, the backbone of that wasn't set up in 2008 when this all finally began to collapse. I mean, we're kind of on life support as an international monetary system ever since. But the Chinese and their trading partners have used the intervening 7 years to plan and set up the foundations for the next system. Whether or not they're ready, today in late August of 2015 is immaterial. They will be ready at some point. At that point, again, we've ceded our financial future into their hands. They can pull the plug on it whenever they want, and that's the most dangerous part of where we're headed.
Tim Sinclair, I said just this last week that we don't get, this is the pre-crash basically, this is the warm-up act, and we don't get out of September without a real crash, without the real thing, I believe was his exact quote.
Yeah.
You're a market guy, a Wall Street guy, have a lot of experience in Wall Street. What do you think about that statement?
I always go back to what I learned a long time ago when I first started as a stockbroker in 1990, which obviously shows how aged I am at this point. I worked for a company called Payne Weber, and Payne Weber has morphed into UBS over the last 10 or 12 years. There's a guy there that is still the floor manager on the New York Stock Exchange for Payne Weber. His name is Art Cashin. I don't know if you've ever talked to him, Greg.
I have not talked to him, but I know who he is.
He'd be a great guest.
Yeah.
Anyway, Art always used to say, you don't want to go around predicting the end of the world because you're only going to be right once. Yeah. And it's like, and when I was a stockbroker, I was told once by an old wise stockbroker, you never want to give date and price in the same sentence because it's one thing to say that Walmart's going to 50. It's an entirely different thing to say Walmart's going to 50 by Christmas. And so so as strange as it sounds, I'm not one to, go around saying, by September, this has to happen. But there are a lot of folks on that bandwagon, whether it's that Shemitah cycle that is very popular for people to discuss, or just simply how terrible things look. I mean, the commodity markets, absent the last couple of days, commodity markets, there are indices for the commodities that are at 20-year lows. I mean, there are a number of indicators out there that show that the global economy is a total wreck. So yeah, it could very well happen in September, but I'm not going to put a flag in the ground and say if it doesn't happen by a date certain that everything must be okay.
But let's just say this, though. What I'm hearing from you is that there's plenty of ammunition to say that, no, things aren't blue skies in green, grassy fields, and that there's a lot of data out there. They keep cramming this, recovery story down our throats.
Right.
And so there is a lot of data out there, Baltic Dry Index, rumors of war, we'll get that in just a second. A lot of data is out there that says that things aren't looking good, at least for the last part of this year.
What's hard for I say regular folks because guys like you and I, me in particular, are probably irregular in that I live this stuff on a daily basis. I mean, I'm wired into this, 10, 12 hours a day, 6 days a week, where most people are living their lives, and out socializing and raising their families and all that kind of stuff. And so it's probably hard and I have found it to be hard for a lot of people to understand that, and you're dealing with normalcy bias as well when you're talking to people. But the whole thing is a charade. It is akin to a movie set, in the Old West, You know, if you had like Blazing Saddles, remember in Blazing Saddles where they have the big fight scene and it's just a fake town?
Yeah.
Okay, and the town falls over. Nothing's real. I'm not exaggerating. That is the world that we live in from a financial sense. Everything died in 2008.
We have no markets.
What's that?
We have no markets, is what you're saying.
We have the illusion of markets, Greg. And that is propped up on a daily basis by the financial media, who has an interest in propping it up. They parade money managers on there who have an interest in making it seem like all is well because they're collecting fees. And they have the Fed pretending to be in control through their interest rate policies and trying to make it sound like the economy is doing just fine. Well, what do they have to do? They have to double and triple seasonally adjust their GDP data to make it positive. They have to run all these statistical adjustments like the birth death models and seasonal adjustments to the employment data to make it sound like it's okay. And all of it is, it's a hall of mirrors, a charade to try to convince everybody that it's okay. All the way down to the individual stock market level, Greg. When I first got into this business 25 years ago, there was an actual functioning stock market. You know, there was mom and dad buying 200 shares of Coca-Cola and, you know, an old lady buying some preferred stock, and there was somebody buying $25,000 in a mutual fund, and it all was done, and some of it was done by computer, but it was all buyers and sellers, actual real people. Now, 75% of the volume of listed stocks is done by high-frequency trading computers.
Criminal.
And
They just beat a court case in appeal. They just beat, they won the traders, the front runners.
Don't get me started. And you know, Michael Lewis wrote the book about, and he stated it's all rigged.
Yeah.
And everybody went crazy, but he didn't go far enough. He's right in that it's rigged against the individual investor, that if you go in there and you're trying to trade against these computers, they'll front run you and you lose money and all that stuff. And that's true. But where it's really rigged is the entire thing is rigged through these computers. And what I mean by that is the central banks are desperate to keep this illusion of normalcy. And to digress for a second, to think that all of a sudden they're going to lose control by September, they might, but we've also found that, you know, they've been able to keep some measure of control and keep this charade going for 7 years. They could probably even still go longer. But what they do, what these central banks do, the way they influence the markets to move higher, is they influence these high-frequency trading computers to do the work for them. And these computers are programmed to buy or sell stocks, buy or sell the major index futures like the S&P 500 based off of certain signals, whether it's the VIX index, which is the volatility index, or this week, it was egregious, the linking of the S&P with the U.S. dollar, Japanese yen currency pair. And so
that's how they got the big downturn. Then they got it to come back up, and everything's fine. You're saying it was total manipulation. The downturn wasn't manipulation. They weren't ready for that, but they got in there and they did millions of trades a second with their high frequency trading.
Right. The downturn was economic Mother Nature overrunning the Fed's and the other central banks, Bank of Japan, the ECB's efforts to massage these indicators well enough to keep the market going up. They got overrun by the HFT, and without the circuit breakers Monday morning, the market was completely broken. In the days since, however, banks like the Bank of Japan, the Fed, have been selling yen, buying dollars, and driving just this one foreign exchange pair, the U.S. dollar versus the Japanese yen, driving that higher. The computers, the high-frequency trading computers, see that indicator going higher, and it changes their allocation to buy stocks. You held up that cartoon earlier. If I had a chart handy, I would show you the chart from, Thursday, where it is a perfect one-to-one correlation of the S&P 500 and this one single currency pair. It tells you it is all an illusion. It wasn't you and I sitting around yesterday morning going, Greg, I think the market's undervalued here and the economy's so strong, I'm going to buy some stocks here because they're a bargain. No! Now that's what CNBC would want you to believe. But that's not how it works. It was the very same computers that were running off their algorithms, dumping everything in sight uncontrollably Monday morning. Those very same computers were buying things back on Thursday based upon some of these indicators that the global central banks were able to massage in a positive way. And that is your stock market. And
that's a dicey market for anybody with money. That's a dicey, You just go into you might just hand your broker money. You just might just say, here's my money.
Greg, I will go one step farther. It is a fraud. It is a charade, and it is a scam. And that type of thing, though it can work for a while, I mean, Bernie Madoff pulled off his Ponzi scheme for years.
Yeah, until one day it was over. I mean,
exactly. They all reach a point where they don't continue. It's economically impossible. And as we saw, it is possible for all of the efforts of these central banks to be overrun. We saw that late last week and into last Monday. That day is coming again. That is no doubt. And it can be set off by any one of a number of things, like the China situation that we started out discussing earlier.
TF metals. Let's talk about the metals. I mean,
sure.
It's unbelievable. I mean, silver's at around 15, and people are complaining, oh, I got metal, I got, creamed on my trade, which I've always told people, don't trade. You need to accumulate and hold this metal and be strong enough to take and hold whatever metal you have at whatever price, because one day it'll be, and just like Bernie Madoff's fraud you were talking about, I mean, you realize he went to his Hampton home on a Friday, one weekend. And on Monday, the FBI were in his office and cuffed him, and boom, that was it. That was the end of Bernie Madoff. So frauds end quickly. And I tell people, I say, don't worry about that dollar price. You're trading. You get this trading mentality. I'm not a trader. You have also, a former UK advisor to Prime Minister Gordon Brown saying, buy canned food and buy bottled water. Oh, and get money out of the bank and hold it in the same place. And then we hear late last week HSBC having problems making some payrolls and paying some people and holding up money. And HSBC reported. And what do you think about this situation where, the bank, you can wake up one day and no cash, no food, no water.
Like Greece.
Could it happen?
Just like what happened in Greece 2 months ago, where you have an allotment from your ATM every day of $40 or 60 euro. That is definitely a possibility because the banks are still just walking zombies. And the whole system, like you said, you could just wake up one day and it's a bank holiday. And then what do? That's one of the reasons why you hold physical precious metal somewhere nearby, so that you have it as an insurance policy to some extent. And additionally, why folks save in dollars or any other fiat currency when it's the stated goal of all these central banks to create inflation by devaluing that currency. They're devaluing all of your saved up hard work, all of your savings. You should be saving in gold and silver, not dollars and yen and euro. But that's kind of another story. You were asking about the metals markets.
Yeah, when is the manipulation going to stop? Are they going to run out of gold? Are they going to run out of silver? What's going on with that?
That's when it will stop, when finally there is no physical metal backing these paper derivative trades. But for now, it's still run on the same paper Ponzi scheme derivative schedule that they've run since 1975. There has to be physical delivery made at that artificially derived paper derivative price. For now, there still is. And so the price has legitimacy. But we're seeing tremendous scarcity, notwithstanding all of the gold that's flowing east. I mean, there's all kinds of anecdotal stories now of just general scarcity in the wholesale market for silver and gold, because prices are not in an economic place where you have equal amounts of buyers and sellers. And so one day that will all get rectified. But for now, these prices set by these paper markets, it's 90% of the people that trade or traders that attempt to trade the COMEX futures markets get wiped out in 90 days. They completely lose their accounts because they're rigged. They're schemed by the bullion banks who have the books, who know where the orders are, and they're there just to clip you for their own profit. And so trading precious metals on the COMEX is a loser's game. People still try to do it, and they still ask me for advice and price points and stuff like that. But boy, the only winning move is to continue to prepare for this event that's brought about by the unsustainable nature of global debt. And the best way you can prepare is to always be stacking some physical precious metal for when that event finally happens.
And isn't this why that we have this tremendous demand? This isn't just like mom and pop going to buy 2 Eagles.
Right.
Going to get, I'll have $100 of junk silver. I mean, this is big demand. Doesn't that mean that the rich and the heavy, strong hands are accumulating this hand over fist, or am I wrong? Is this fantasy?
I wish I could answer that one with definitively, because we don't know. The rich that are buying, a ton of silver or 100 ounces of gold or whatever. They're not out telling anybody about it. And most of that is done through London. That's still the heart of the Western physical market. And the London market is so ridiculously opaque that you really don't know how much gold is being offloaded. We get these anecdotal reports about gold leaving London and that their vaults being empty and it's flowing to Switzerland, where the foundries there are working 24/7 shifts, recasting it into kilo bars. And then we get the import-export numbers that show all the gold flowing from the U.S. and London into Switzerland and back out of Switzerland. So there are all these kind of anecdotal dots that are out there. But to say with certainty that this is exactly what's happening, we can't. All I know is from my experience and from talking with people that I trust, it's clear to me that we are in a position where the Western world is running out of physical metal. We have hitched our wagon to fiat currency. And it's every fiat currency system that the world has ever devised, going back to ancient Rome, has eventually imploded. And we're headed in that direction as well. And the next logical step will be some type of hard asset backing again to give the system some roots, some actual foundation in the ground so it doesn't waver and twist in the wind like our current system does. That will no doubt include gold and silver. It's like, when you were talking to Jim Sinclair last week and he mentioned how this next rally maybe you won't sell. Isn't that what he said?
Yes.
Yeah. And
it'll go up and stay up.
I know exactly what he's saying. Yeah, because...
Explain that to me, because some people didn't get that. And I got it, because it's like it's going to just be totally revalued. It's just not a trade.
Right.
It's not going to be a, we have a lot of beans this month, so there'll be $7 a bushel instead of $15 a bushel.
Right, right.
You're talking about, explain that.
In the end, it gets to understanding, what are you doing when you're selling? Well, when I buy gold, I am exchanging my devaluing U.S. fiat Federal Reserve notes for gold, something tangible. If I were to sell gold, I'm exchanging it back for the fiat currency, right? And that's at the core of it. That's what it is. I do not see a situation on this next rally where you'll be switching it back into the currencies that we have now. You may convert it into some other hard asset. You may convert it into some type of whatever the next current global currency regime is or something like that. But the next rally is not going to be one where, hey, look, gold went from 1,100 to 1,600. I made 30%. Isn't that great? And you cashed out for dollars and then go put your dollars in the bank. I mean, that's not what when this finally breaks apart, that's not the situation that we're talking about. That makes sense? You see what I mean?
That makes sense. You're going to get a new currency, or get a new
Jim
value.
Was saying, and I firmly believe he's right. Yeah, and the other thing that I would add to Jim's point, that these numbers get thrown about what's gold actually worth. Some folks like to divide the amount of ounces we allegedly hold in gold in Fort Knox by the M1 money supply. And you get $6,000 an ounce. Or if you divide it by the M2 money supply, you get $12,000 an ounce. And you get numbers 50,000, like Jim said, or 64,000. And I would say, really, it's an impossible calculation to make because we don't know how much gold there is in the first place. You can't come up with that. You can't solve that equation without knowing that variable. If there's no gold left to be had anywhere in the West because it's all in China and everything that's supposedly held here has been rehypothecated 100 times and there's 100 beneficial owners for every ounce, you don't know how much there is. And if you don't know how much there is, you'll never know how much gold is actually worth until we get to that point. And so this guessing game of it's going to be $20,000 an ounce is really just that. No one really knows how high gold will go to or what its eventual dollar conversion value will be until we know how much gold there actually is.
And here's what I wanted to bring up. Somebody said, a couple of people have asked me this. It says, ask your next guest in TF Metals Report, so I'm going to ask you. Ask your next guest if there'll actually be a buying power increase. You'll actually be able to buy more with your gold, or will it be a nominal increase? In other words, $50,000 an ounce and a loaf of bread is, $5,000, right?
It's probably at least that. That gold is, an ounce of gold could always buy you a good suit in London 100 years ago, or there's that ratio that some folks follow between a barrel of oil and an ounce of gold, and, that how that should always be, 30 times or whatever the number is. Those ratios will probably still hold sway, but again, getting to the bottom of it, though.
You don't know whether you'll have actually more buying power, or you know it'll hold your buying power. It'll keep you being wiped out.
Yeah, there's no question about it. It gets back to why do people save in dollars where you're losing buying power. You worked your rear end off to get a paycheck, and then whatever you have left over, you save, and then the Federal Reserve just prints more and more dollars, and your savings are devalued. Why you want to save in dollars, I don't understand. But the bigger point again, we don't know how much gold there really is. You know, you can say, well, they mine 8 tons a day or whatever it is, fine. But is there really gold, and is there clear title to the gold that's still in the West? And absent knowing how much is available to be bought, you really can't put a price on it that, you know, it's going to 20,000, and so therefore it will outweigh how much bread you can buy and how many suits you can buy. Because again, I think because this system is so over leveraged, the derivative scheme has been pushed to such an extreme that, you know, there's maybe on the COMEX, there's 100 ounces of paper gold for every 1 ounce of actual physical gold that they have that's ready to be delivered. You don't know how much gold is actually there, and so therefore it's impossible to really determine what the end price will be once the system finally breaks.
I think people are asking me, will they make money on gold? And I just think you're asking the wrong question. You're asking, do I have an insurance policy if this thing breaks apart? Will I have any buying power for anything? Will dollars have buying power? The answer is probably no.
Yeah.
And, you know, they won't go away, but they certainly won't be any kind of buying power they have now. And that's really, it's an insurance policy. I hate to tell people, yes, you'll make tons of money. No, that's not why you, right? Is that what you're saying?
How do you know you have from the guy with a $10,000 401k to a guy with a $10 million portfolio, you know, with Merrill Lynch? How do you know you even have that money? I mean,
they could seize all that.
It's a bunch of zeros and ones. You have your statement. That's all. And if you ask for cash, they send you some, I guess. But how do you even know that you have it? Gold and silver, you know what you have. And that is why in the eventuality of this, I don't know, collapse maybe is too strong of a term, eventuality of change that is coming. Having physical gold and silver to protect your accumulated net worth, to protect your buying power, to protect your ability just to get everyday things. Again, we saw in Greece what happens when there's a bank run and the banks are illiquid. I mean, do you really want to be standing at your local ATM hoping to get $48 out today so you can go buy some groceries? I mean, it is the fact that gold and silver are down, that the paper trade through these high-frequency machines has driven the paper price down. We should actually all consider a blessing because we're able to buy more. The time that the system has been propped up the last 7 years is a blessing because we've all been able to prepare more, like the Chinese, for when it really does break next time and it's unfixable. And so
you think that? Wait, hold on a minute. So you think the next time it breaks, it will break hard and they won't be able to roll in. That's what the BIS and Fed and everybody else is saying, that they won't be able to fix it next time. Is that what you're saying?
Yeah, and I'm not saying that the dollar's going to go away and there's going to be some one world currency. Maybe there will. I just think that the dollar is going to lose purchasing power and value dramatically. We've been summarily just printing dollars and shipping them all overseas for 40 years. And those dollars are currently tied up in our bonds, and they're tied up as foreign currency reserves of other nations that have been forced to soak them up. But as the dollar loses its reserve currency status, which it's going to do because we're not using the same reserve currency from 100 years ago or 1,000 years ago, these things change. And when it changes, all of those existing dollars are going to come home and devalue in multiples the ones we have now. And inflation is going to go through the roof, and it's a totally different world. And again, that's probably a best case scenario. Greg, frankly, what I really worry about is that transition from one financial system, financial scheme to the next is never done peacefully. The hegemon that has the power, that has the printing press, that is the reserve currency, they don't just like sit back and go, oh, okay, you're right, we've had our time in the sun, now it's your turn. No, man, they fight as hard as they can to protect and defend that. And that's what I worry that's my biggest concern is the transition from one system to the next and what that holds for all of us.
And I wanted to bring up the Yemen thing. I mean, late last week, here, Saudi Arabia invading Yemen. And, man. They know this deal's going to go through Iran. And there is no inspections. They're going to give them all their money back in one shot. There are no real. Come on, there's no verification. That's a total lie. And everybody in the Middle East knows that, including Saudi Arabia. So do you think what they're doing, running into Yemen and saying, okay, we're going to snuff this out right here and now. We're going to go in. And what does that tell you about gold and oil and everything else?
It has implications toward all that stuff, Greg, no doubt about it. Everyone knows on the other side fighting against the Saudis in Yemen, it's a proxy war between Saudi Arabia and Iran. And the Saudis that's not a very stable regime either, but yet they are really the key cog in the whole dollar recycling scheme that's been in place since the mid-'70s, because crude oil is priced in dollars. It's not priced in euro and yuan or anything like that. And so the Saudis, they call that the petrodollar, the Saudis are kind of the linchpin to this whole thing. And if the Saudis teeter and fall, that just speeds this whole thing we've just spent the last 10 minutes talking about. That speeds up this entire process of just weakening and taking out the dollar as a reserve currency. And so, that conflagration there is a proxy war between Sunni and Shiite, between Saudi and Iran. And it sure doesn't seem to be getting any better. I mean, when did this start? 6-8 months ago? And there was a bombing campaign, and then the Saudis said, well, that's it. We took care of it.
Oh, this is ramping up.
Yeah.
Are you worried about wider war in the Middle East?
Oh, absolutely. Oh, absolutely. No question about it. And I don't know if you get a chance to follow on a consistent basis what we do at TF Metals Report, but I am scared to death and have been for a year and a half where we're headed in Ukraine. That's clearly a new Cold War that we've somehow, for some reason, struck up with the Russians. Again, thinking that we held the cards, that we could bully them. And that situation now is a hair trigger. And we've pumped in all these so-called advisors, a whole bunch of troops in the Baltic states. Can you even imagine if suddenly a handful of those guys are killed by a roadside bomb, or or if the president of Ukraine suddenly something happens to him and it's blamed on the rebels in Donetsk? Guys like John McCain and these other folks are going to go bananas, and that situation could get out of control really quickly too. As I said, my neighbors and my friends, man, they're just normal people. They don't have to deal with all this garbage on a daily basis that I do.
Let me get back to Saudi Arabia and Yemen. I mean, could this spark it, get it going with Iran and Saudi Arabia, and they could say, okay, we're going to really go after Saudi Arabia. Could that happen?
There have been a couple of times in the last few months where there were flotillas of ships that had left whatever that Iranian port is there in the Persian Gulf, that were headed there to replenish the supplies and rearm those Houthi rebels there in Yemen. They've turned around a couple times and didn't do it, but I mean, if this is going to be a hot shooting war, more so than just the Saudis bombing, it's totally unpredictable. And isn't war all about unintended consequences and unforeseen circumstances? I mean, God only knows where that could go. We've seen a tremendous kind of short squeeze in crude oil the last couple of days, the last week, from $38 up to $42, $44 a barrel. Yeah, it could come back down, and all those deflationary pressures that brought it down from 110 to 44 are still there. But boy, you get some of this geopolitical stuff going. And I would further add, I mean, again, not to make it sound like I'm some kind of tinfoil hat guy, but when there's just a story this week about Saudi Arabia running a huge budget deficit.
Yeah. They get problems.
Right? Because their oil revenues are way down?
Yeah.
How are you going to drive the price of oil back up? Oh, I know. Let's start a war with Iran and close off the Persian Gulf. And Yemen has that port and that military base right there on the Gulf of Aden or whatever it's called that leads to the Red Sea and the Suez Canal.
Yeah.
So you want to choke off oil and drive price up from 40 to 80 to 100 real fast? Well, there's a good way to do it. I don't know if it's a quid pro quo that suddenly that happened today, but
that could happen.
Yeah.
That could. I mean, oil could spike unbelievable if they really get into it. And Iran says, well, we're not going to take that. These are our people down there. You can't annihilate them.
Well,
I mean, who knows? I mean, this is a UGG League getting together for a party. UGG and League getting together for a party. I mean, this whole thing can turn ugly and hot, right?
Well, it's not just the Saudis the Iranians benefit from a higher oil price too. So they both have incentive to stir the pot and drive price back higher. And so, I don't know. Again, maybe it's just a coincidence, and maybe I'm just cynical after all these years. But I see that headline today after what we just saw out of Saudi this week, and we see the price breaking down and looking like it's going to go even lower, and then all of a sudden we have a hot war in Yemen? Really?
Yeah.
Wars have been started over less.
Craig Hemke, TF Metals Report. We'll put a link to your, you have public information on TF Metals Report, and then you also have a sign up. I think it's, what, $10 a month?
Yeah, first and foremost, it's a vibrant community of people that they post probably more quality content than I do. And everybody's looking out for each other. We all recognize where this is headed. And so if you're
everybody wants to know when. That's the big thing.
Yeah,
when everybody knows it's terrible, it's bad. There's enough data out there. It's not a fantasy.
Right.
The fantasy is that you're thinking that everything's okay. It's not a fantasy.
And it's going to be ugly. And it's not like I'm sitting here going, oh, I can't wait because I'm going to stand on my desk and beat my chest and tell everybody how smart I was for predicting all this. It's going to be horrible when all this comes. So it's not something we're looking forward to, but we're all there to help each other prepare. What I do, I don't know, after all these years, I got a pretty good handle on gold and silver, and so I provide some guidance as to where I think prices are headed in the short term for, like you said, a whopping 50 cents a day, $10 a month. And it helps me keep the lights on, pay for the servers, and that kind of thing. But it's a great online community of folks that, just like you and I, that know that something's amiss and just want to prepare and plan and talk to some other folks that, that see it the same way. I'd encourage everybody to check it out. It's tfmetalsreport.com.
I will put a link up to your site, of course, and also to your sign-up page. You'll send that to me. Craig Hemke, thanks so much for joining us today on USAWatchdog.com.
Greg, it's always a pleasure. Thanks.